Section 3, how transactions change owner's equity in the accounting equation. So we have a new account called revenue. This will increase the owner's equity resulting from the operation of a business. So think of it as you brought money in, or you sold something to someone and you brought money in. So that's a revenue. So a transaction for the sale of goods or services is revenue. So when you read in the transaction that says sales on account, this affects our sale for which cash will be received at a later date. Anything that says on account will either be at a later date that we owe or we will receive. Another account will be expense. This will decrease the owner's equity resulting from operation of business. So a transaction to pay for goods or services needed to operate a business. So think of it as expense will be a telephone bill, advertising expense, equipment or rental repair, charitable contributions. These are all types of expenses. So these are bills. Another account that will affect the owner's equity would be withdrawals. Withdrawals would be assets taken out of a business for the owner's personal use. So the owner owns the business, he invested money into the business, now he's withdrawing money from the business for his own personal use. So that would be withdrawing. So this decreases the owner's equity and assets. So transactions would be read as paid cash to owner for personal use, or it might say withdrew cash for personal use. If you see any one of these two transactions, this is a withdrawal that decreases our owner's equity. So to read some transactions, so on the assets we have cash, supplies, prepaid insurance, accounts receivable, liabilities, we have accounts payable, owner's equity will be our capital, which is affected by our revenue, expenses, or withdrawing. So we either add revenue, decrease expense, and decrease withdrawals. So this would be an accounting equation. And that is section 3.